Okay, so let's continue from where we left. Let's continue from where we left last time. Last time we were doing a question, or we were discussing, the topic of published accounts. That's what we were discussing. And you can see we went through what are the components of a complete set of financial statements, those 5. We talked about the statement of financial position. We talked about the statement of profit or loss and other comprehensive income. We talked about statement of changes in equity. We talked about statement of cash flow. We talked about accounting policies and explanatory notes. From there, we discussed how to prepare. What we were calling the statement of changes. The statement of comprehensive income. Just to remind you, let me just show you where we prepared it. Oh, where is it? Here. We looked at, maybe it's the format we wrote down was where? Let me take you back. Here. This is where we prepared the statement of comprehensive income, or what you can call statement of profit or loss. So that's how we prepared it. After we prepared it and we discussed several items, of course, we shall come back to them when we are doing a question. We shall come and review them again. From there, I can see we discussed how to treat, you can see how to treat interest on debentures. Where it's partly paid and where it's not paid and so on. That's what we discussed. You can see those 2 cases, case number 1 and this case number 2, where no interest is paid. After we discussed that, we discussed about how to treat preference shares, and I told you it's important that if your company has preference shares, you must ask yourself whether you have redeemable preference shares or non-redeemable preference shares. We talked about it in details. Of course, if the question will have it, today we want to do a question. We said if the question will have it, we shall look at it. Then we wrote down the notes on how to treat the redeemable and non-redeemable, and even their dividends. How do you treat preference dividends on redeemable? How do you treat preference dividends on non-redeemable? We said they are not the same way you treat them. You don't treat them the same way. Good. After that, I can see we discussed how to deal with the deferred tax. When to debit deferred tax, when to credit deferred tax, how to treat the transfers to, transfers from, increased by, reduced by, all that language, we discussed it last time. Then from there, we discussed how to prepare a statement of financial position. That's the balance sheet and what is required. We also discussed how to prepare what we called statement of changes in equity. You can see how we prepared it. Okay, so I think that's what we had done. So today, I want us to do a question. To apply what we have done, or discussed previously. So the question I want us to do is a question of November 2015, question number 1. November 2015, question number 1. That's the question I want us to do. So I want us to project it. So that we read it together. Then from there, now we do the question and we apply what we learned previously. So let me project the question. Now. Let me project the question so that we do it. There it is. That was the question of November 2015. Question number 1. It was November 2015. Question number 1. I want to read it. It says, Dollar Limited, a quoted company dealing with household goods, has prepared the following trial balance as at 31st of December 2014. So in that trial balance, you are given revenue, you are given loan interest paid, you are given purchases, you are given distribution cost, you are given administrative cost, you are given interim dividends paid, You are given inventories as at 1st of January 2014. Don't forget the trial balance we were told was as at 31st December 2014. So that means 1st January 2014 must be the opening stock. Then you are given trade and other receivables, cash and cash equivalent, ordinary share capital or ordinary shares of 10 each, share premium, general reserve, retained earnings as at 1st of January 2014. That must be the retained profit brought down. You are given the loan payable in 2024. Then you are given land and buildings. You are given the cost. Let me roll the question. After the land and buildings, you are given land and buildings. You are given the cost of the land is 60 million. Of course, you can see land and building. You are given the cost of both in the column of the trial balance as 380. But out of it, I can see they are saying the cost of the land is 60. I hope you can see that in bracket, meaning that the cost of the building is how much? 320. I hope you can get that. Then you are given accumulated depreciation. Then you are given plant and equipment at cost and accumulated depreciation. Then you are given investment property as at 1st of January 2014. Then you are given rental income. Then you are given proceeds from sale of equipment. Additional information. Number 1, closing stock or closing inventory as at 31st of December 2014 amounted to 388 million at cost. However, shortly after the year end, some inventory with a cost of 15 million were valued or were sold for 8 million. We shall discuss that in a short while. Number 2 says land and buildings were revalued on 1st January 2014 to 800 million, including land shillings 100 million, including land at 100 million, and buildings have a remaining useful life of 40 years. We shall discuss that. Number 3, the income tax liability in the year was estimated at 20 million. Deferred tax was to be provided at 7 million. Number 4, during the year, the company sold some equipment which had cost 15 million with an accumulated depreciation as at 1st of January 2014 of 3 million. An item of plant was also estimated to be impaired by shillings 4 million during the year. Number 5, let me roll the question. Number 5. Number 5 says depreciation rate as per the company's policy are as follows. Buildings over its useful life period, plant and equipment, you are reducing balance 20%. The company's accounting policy is to charge a full year's depreciation in the year of purchase, in the year of assets purchase, and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sale, and on land and building as an administrative expense. Number 6, Dollar Limited values investment property at fair value. The fair value of the investment property as at 31st of December 2014 was 586 million. 7. During the year, the company made a 1-for-3 bonus issue, capitalizing its general reserve. This transaction has not been accounted for. Next. Next, wamesema required prepare in a format suitable for publication the following financial statements for Dollar Limited for the year ended 31st December 2014. 1, income statement. Number 2, statement of changes in equity. And number 3, statement of financial position. Note, Notes to the financial statements are not required. Notes to the financial statements are not required. Good. So I want us to go now through the question now and do each first. We want to do the workings. From the additional information, let's see whether there are any workings to be done, whether there are any workings to be done from the additional information. Good. Now, before we do the question, listen to this now. Before we do the question, especially for the new students, there are new students who have joined us today because today is a free class. I want you to listen. In case you are disconnected, whenever you're watching a live video, in case you are disconnected because your Wi-Fi strength is weak, there are two ways in which you can come back to class. Sometimes you may be disconnected when you are watching a live class. One way of coming back to class is this. Listen, first let me don't talk about the way. First let me talk about the way you should. Do not click on the disconnected video. Sometimes you click on the disconnected video and it doesn't take you back to class. Sometimes you click on the disconnected video and it doesn't take you back to class. So if that does not, you may try it. But if that does not, then we are saying to come back to class, you can refresh your page. Normally, on the page you are watching the video from, either on the top left or on the top right, normally there is a refresh button, which normally looks something like this. There is a refresh button, which normally looks like that. If your gadget has it, whether it's a laptop or a mobile phone, if it has that, you can refresh your page. That will bring you back to class. If that does not bring you back to class, then you can click. You go back to the group where the link you received, you go back to the link or the group where you received the link, and you click on the link again, and you click on the link again. So those are two ways in which you can come back to class in case you are disconnected. Maybe you click on the disconnected video and it doesn't take you back to class. You can come back by refreshing the page or by going back to the group where the link was posted. That only applies when you are watching a live class. Good. Another thing maybe for everybody now, before we continue, for everyone now, please, as you are watching, you can subscribe. You can subscribe to my YouTube channel. As you are watching, you can still click that subscription button. You can still click that subscription button, and you click also the notification bell so that in future, you may be notified whenever I post videos in the YouTube. So please subscribe to my YouTube channel as you're watching, so that you may be receiving notification of new videos being posted to the group. Good. So now with that information now, let's go back now. Let's go back. So let's go back to note number 1, note number 2, note number 3, and deal with them first accordingly to see whether there are any workings to be done. Some of them are just there for information. Some of the additional information requires some workings. So those which require some workings, we need to do. So let's go back. Let's go back to note number 1, note number 2, note number 3, number 4, and so on. Number 1, what does it say? Note number 1 says, the closing inventory as at 31st of December 2014, the closing inventory as at 31st December 2014 amounted to 388 million at cost. However, shortly after the year has ended, some inventory with a cost of 15 million was sold for 8 million. So let me explain. First, of course, the examiner here is testing you on how do you as a company value your stocks. How do you as a company value your closing stock by the end of the year? There is always an accounting policy of valuing stocks. And the accounting policy for stock valuation, I hope you know, is saying or says stocks should always be valued, don't write, stocks should always be valued at the lower of cost and net realizable value. That is always the policy of stock valuation, that stock should always be valued at the lower of cost and net realizable value, whichever of the two is lower. Maybe you have some stock which had a cost of 20,000, but its net realizable value, when you shall sell that stock, maybe it will realize 25,000. You have not sold it, but the moment you will sell it, your net realizable value as a company will be 25,000. So you should value this stock, because it's still in the store, you value it at the lower of cost and net realizable value. Whichever of the two is lower, that's what you use. So for this case, I would use 20,000 as the closing stock. Are you there? Now, another point. What if for whatever reason the goods will be sold, or for you to sell the goods, you will realize? What if you will realize 15,000? I have said you have not sold the goods. These goods are still in the store. They costed you 20, but when you shall sell them as a company, for whatever reason, you will realize 15,000. You will realize 15,000. In most cases, stocks should be sold at a higher value more than the cost. But there are circumstances when you may be forced to realize less than the cost, like in this scenario. So here, this stock has a cost of 20, but when we shall sell it, we shall realize 15. So when I'm going to value it by the end of the year, I choose whichever of the two is lower, and therefore you will value it at 15. Now let me take you back to the scenario of this question. Let's now understand the scenario of this question, having now known that our stocks should be valued at the lower of cost and net realizable value. Then note number 1 said, our company had a closing stock which had a cost of 388. However, shortly after the year end, some inventory which had a cost of 15 million was sold for 8 million. Now listen, you had a stock which had a cost of 388 million. That was the value of your closing stock at cost. Then shortly after the year has ended, listen, and before the accounts were finalized, shortly after the year has ended, and before the accounts were finalized, there is one bunch of stock which is part of this, which costed 15, but it was sold for 8 million. Meaning it was sold for less than its cost. Now, I have told you, listen, this happened shortly after the year has ended. There is an accounting standard which we normally call a post-balance sheet events, which means if an event takes place before the accounts are finalized, shortly after the year has ended, but before the accounts are finalized, for publication, then that accounting standard says you should do an adjustment to the previous accounts. So it does not even matter. Let us assume, listen, let us even assume the question told you that this stock had a cost of 388. Even by the end of the year, at the same end of the year, 31st December, one bunch of it costing 15, let us assume you are told it will be sold. It will be sold for 8 million. Whether it has been sold or not, it will maybe be given. Some questions give you that way, that it will be sold for 8 million. The consequences or the concept is still the same here. So what is the true, listen to this now, what is the true value of your closing stock? Will you take to your balance sheet a stock of 388? The answer is no. So that's what we want to determine. What is the true closing stock. It is not 388. So let me first explain before we put down the workings. So first, what you will do, you will take that 388, you remove the stock which has an issue now. That stock which has an issue has a cost of how much? 15. Once you remove that 15, now you remain with a bunch of stock which doesn't have issues. That will be 388. If I minus 15, that will give me 373. That is a bunch of stock that does not have issues. Then you now remain with this second bunch which has some issues. What is the issue? It will cost, or it has a cost of 15, and it has a net realizable value of 8. So at what value should you include it in your closing stock? You should include it at the amount which is the lower of cost and net realizable value. And that means you will include what value? You will include 8 million. So out of 388, 373 is a stock which is clean. Then you bring in the stock with an issue, now bring in the right amount, which is 8 million. And that will come to 373 plus 8, that looks like 381. So in your stock valuation, you will now be required to use a value of 381 million as your closing stock. Okay, so I've given you what the examiner was testing you there for closing stock. What that note number 1 was testing. It was testing you on how to value closing stock. So maybe we can put down that information now. Now we can put down that information now. So let's put down the information concerning note number 1 now. Maybe you could even put down note 1 to remind you when you are revising that you are dealing with note number 1. You are dealing with note number 1. Then you can say this. Put down this. Put down this. Stocks should be valued. Stocks should be valued at the lower. Stocks should be valued at the lower of cost. Stocks should be valued at the lower of cost and net realizable value. Stocks should be valued at the lower of cost and net realizable value. Good. That's the principle. Then below that, you can now say here, valuation of stock, valuation of closing stock. Let us now determine our valuation of closing stock. Then you can come and say your stock cost of stock without issues. Cost of stock without issue. We are getting it by taking 388, which is the general, and you minus the cost, which is 15. And that gave me 370 what? 3. You remember? That gave us 373 million. Then I now come and add value of stock with issue. Value of stock with issue. We have agreed one component, one stock cost 15, but it was sold or it will be sold, whichever way. Whether the question tells you it will be sold or it has been sold for 8 million, whichever of the two is lower, which is 8. That gives me now 381 as the value of closing stock. This is value of closing stock. So that's all note number 1 was testing you on. That's all note number 1 was testing you on. How to value closing stock. How to value closing stock. Good. So finish. We want to go to the note number 2 now. We want to go to note number 2 and look at what is it the examiner was testing us on. From that note number 2, we want to discuss all the additional information first. If there is any workings we do, and If the information is just, if the note is just to provide information, fine. Then once we have done all the additional information workings, now we can go and prepare our income statement, or what we call statement of profit or loss. Good. So that's all for note number 1. Let us go and read note number 2 to see whether there is something we can do there. Note number 2. Note number 2 says, land and buildings were revalued. Land and buildings were revalued on 1st January 2014. 2. Land and buildings were revalued to 800, including land 100. So from that statement alone, if both land and buildings were revalued to 800 and land on its own was revalued at 100, that tells you that the building was revalued to 700. I hope you are getting that point. Then you are told building had a remaining useful life of 40 years. So there are several things the examiner is testing you. 1, depreciation on the buildings from now onwards. Listen carefully. This company, they revalued their land and buildings not at the end. They did not revalue their land and buildings on 31st of December 2014. No. Get the point? They revalued their land and buildings on 1st January 2014. I have told you, land and buildings were both revalued to 800. Land at 100. Meaning the building was revalued to how much? Building was revalued to 700 and land was revalued to 100. I have said, listen, if they were revalued at the end here, then you will not have been required, you will not have been required to depreciate the building. Even though the question may have told you it has a remaining useful life of 40 years, it means we are revaluing at the end of the year, we shall start depreciating afresh next year. But this question tells you land and buildings were revalued on 1st January. So if as at this date, first of the beginning of the year, our land was revalued our building was revalued to 700 and it has a remaining useful life of 40 years, then it means how much will you depreciate it this year by? That's one point. So the examiner wanted you to know how much will be the depreciation charge for the year on the building for 2014. We are depreciating it, not on the original cost. No. Why? Because they were revalued due by the beginning. So if we revalued it at 700 at the beginning, then it's from that 700 now that we shall be depreciating it on. So we shall not use the value in the trial balance, the cost. No. Why? Because we are revaluing it at the beginning of the year. So the value of the building from the beginning is now 700. Good. Once we calculate the depreciation charge for the year, we also need to know what is the gain or loss on revaluation of both the land and the building as at 1st of January. How much was the gain or loss on revaluation? Those are the two things the examiner is testing you on for that. So first, let us depreciate the building first. Let us depreciate the building. So andika somewhere determination, put down determination. We are doing note number 2. If you want to put down that note, so note 2, to remind you, determination of the depreciation charge. Determination of the depreciation charge per annum, because it's on straight line method. Determination of the depreciation charge per annum on the building. On the building. So let's put it 700 million. We divide that by the useful life of 40 years. So what does it come to? What does it come to? I take that 700 million, I divide by the useful life of 40 years. That gives me 17.5 million. So we are depreciating, or we shall depreciate our building from now onwards by 17.5 million per annum. Good. Then, now listen. We want to know what was the gain or loss on revaluation. So finish copying. I want to take you back. Finish copying. I want to take you back to the trial balance. We look at the values. We know land was revalued to 100. We know building was revalued to 700. But what was the original values? Book values. Those are the ones we want to know. Good. Now listen, let's go back to the trial balance now. We go back to the trial balance. If you look at the trial balance, we are given, land and buildings. The cost for land is 60. Both of them, we are given the value as 380. So if land and buildings have a cost of 380, out of which land had a cost of 60, and we are told it was revalued to 100, so what is the gain on revaluation of the land? Let us start with the land. What is the gain or loss on revaluation of the land? That looks like a gain. So come and say a gain on revaluation. Gain on revaluation of land. We are having 100 million minus the book value, which is 60 million in the trial balance. And that gives me what we are getting as 40 million. That gives me what we are getting as 40 million. So that's the gain we shall take to the statement of changes in equity. Remember, we said we have a revaluation reserve column. So we go back and now ask ourselves, what about the building? I want you to listen carefully now. I want you to listen carefully. I would have given you that challenge. To calculate for me. But let me just explain. I would have given you the challenge to calculate the gain on revaluation of the building. Now listen. We have already seen from this trial balance, the cost of land is 60. What that means is that the cost of the building is 320. 380 minus 60, that is 320. Now listen carefully. Do you now come and say 320 minus from 700? Remember, the building was revalued to 700. So do you come and now say 700 minus 320 is the gain? The difference is the gain? The answer is no. That was the trick. That's the one I want to explain. If you look at the same trial balance, you are given land and buildings, cost is 380. Then below that, you are given the accumulated depreciation. It is obvious, listen, it is obvious, the examiner wanted you to know that accumulated depreciation is not for land. We normally don't depreciate land. So it is obvious you must have been depreciating the building. So listen, let me put it this way now. So if as at the beginning here, the cost of the building was 320, we have removed the cost of the land. Land had a cost of 60. Both of them had land and buildings at a cost of 380, you remember, in the trial balance. Then the only issue is, it's true, the building was revalued at the beginning of the year at 700. But you cannot compare these two and say the difference is the gain. That was a small trick. We are comparing the book value, the value at which an asset appears in the books. That is the value we want. So it is not in our books at 320. 320 is the cost. But we are being told this building had an accumulated depreciation of how much? From that trial balance, it had an accumulated depreciation. If you look at the same trial balance, it had an accumulated depreciation of 64. Good. 64 million. So it means, therefore, that the book value, that's the point now, the book value of the building was 320 minus 64. That gives me 256. So 256 is the book value of the building as at the beginning of the year, as at the beginning. Then, at the same beginning of the year, the building was revalued to 700. So what is the gain on revaluation of the building? You now compare that 700 with the 256. So here the trick was that the examiner wanted you to confuse and compare that 700 with the 320, which is the cost. He wanted you to forget that that building was being depreciated. And what I'm given in the trial balance is the accumulated depreciation of the building as at the beginning of the year. Good. So before we get that gain, let's put down some workings. Before we put down that gain, or we get that gain, let's put down some workings. So andika somewhere, determination of the net book value of the building. Determination of the net book value of the building as at 1st of January 2014. Determination of the net book value of the building as at 1st January 2014. We are saying net book value, we know its cost minus accumulated what? Depreciation. Cost minus accumulated depreciation. We have agreed the cost of the building was 320. We have been told the accumulated depreciation is 64. That was 64. So that will give me a book value. We have got it as 256 million. Now we know the value of the building as at the beginning of the year. Now compare that with the revalued amount, which we are given as 700. So this time we have another gain on revaluation. Gain on revaluation of building. Gain on revaluation of building would be 700 minus 256 will give us how much? 700 minus 256. This will give us 444 million. So that is the gain on revaluation of the building. Good. So that's what that note was testing you on. That was what that note was testing you on. Good. Maybe before we continue, I want to know, especially for the new students, I hope the sound is loud and clear. You chat. Able chat and say whether the sound is loud and clear. Are you able to hear me clearly? You chat and say yes. Is the sound loud and clear? Chat and say yes. I want to know whether the sound is loud and clear. Is the sound loud and good? Thank you. Thank you. Sawa sawa. So let's continue now. Somebody has already said yes. So we can now continue. Good. So we are through. Listen, we are now through with note number 2. We are now through with note number 2. The sound is very clear. Thank you. Thank you. So let's continue now. So we are through with note number 2. We want to go to note number 3 and see whether there is any working. If it's just information, we move to the next one. We want to know do the workings first. We want to do some of the workings first. That was note number 2. Number 3, what does it say? Note number 3 says, the income tax liability in the year was estimated at 20 million. That is just information. We shall use it as the amount of the corporation tax or what you normally call current tax. That's okay. We are told number 3, the income tax liability in the year was estimated at 20 million. Then you are told deferred tax to be provided at 7 million. In other words, they are saying you maintain the deferred tax at 7 million. Wamesema deferred tax to be provided at 7 million. So let's open the account called deferred tax. That is note number 3. Let's open the account called deferred tax. We want to know what is the charge for the year. We discussed this last time, how to determine the charge for the year. There are languages the examiner, we said, can bring in when it comes to deferred tax. This is just one of the ways they can test you. Here they are telling us deferred tax to be maintained or to be provided at 7 million. So let's open an account called deferred tax. Normally, you go back to the same trial balance. And bring down the balance. You go back to the trial balance and bring down the balance, whatever it is. That is the opening balance. Normally, deferred tax is a liability, so we always have it as a brought down on the credit side. So let's go to the trial balance and now check what is the opening balance. We are only told by the note that deferred tax to be provided at, which is the same as saying deferred tax to be maintained at 7 million, meaning you carry down 7 million. But what was it by the beginning? What was it by the beginning of the year? From this trial balance, let's go check. From our trial balance, what could it be? If we look at the trial balance, I go down. It seems there was no deferred tax. It seems there was no deferred tax balance by the beginning, but some questions do normally have. But it seems from this question, there was no deferred tax. So let's just bring down a balance of 0. We just bring down a balance of 0. Then, now we are maintaining deferred tax. We are told to maintain it at 7 million. That's what we are carrying down. Then I told you the balancing figure will be what you take to the P&L account. I also told you, listen, when we were discussing deferred tax, let me just show you a few minutes. Give me a minute, I show you somewhere here. We said here, look at it, this. We said when we are discussing deferred tax, I hope you can see here, when we were discussing the deferred tax in the income statement, we said there are times you can add the deferred tax to the current tax. There are times you can add or you can deduct deferred tax from the current tax. So it depends with the question whether you will add the amount of the deferred tax to the current tax or you will deduct the charge for deferred tax from the current tax. That depends. But let's first get the charge from our question. Let's first get the charge. We are carrying down 7 million. We began with a balance of 0. So there's a balancing figure which looks to be on this side. This is balancing figure of 7. Now, of course, listen, we have credited deferred tax with that 7. You have credited deferred tax with that 7, which automatically means you will go and debit P&L account. Just to remind you, listen, don't write the following. Just to remind you, we said if you look at P&L account in a T format, I told you, normally net profit before tax is always a credit. Net profit before tax. Then I told you, from that profit, your company normally pays corporation tax, or what we call current tax. So I told you, current tax is always paid out of profit, and therefore it should be debited. If you are paying corporation tax out of the profit, and profit is always a credit balance, you cannot credit again. You must debit. So corporation tax or current tax is always debited in the P&L account. So in our question, I remember we were given the amount was 20 million. Now, but when we are working for deferred tax, I can see we have credited deferred tax with 7, which automatically means you must come and debit P&L account by how much? 7. And you come and say a deferred tax. Now, then I told you, we normally don't prepare our income statement in a T format. We prepare it in a vertical format, where you prepare your P&L account, you get what we call profit before tax, whatever it is, then you come and say your tax, then you come and say your current tax. Our current tax, we know it as 20, then we shall come and say your deferred tax. This time it is 7. But the question is, am I adding the 7 to the 20, or am I deducting the 7 from the 20? I told you last time, listen, having debited P&L account with that 7, when already there is another debit of 20, I told you, when you are debiting an account which has another debit, automatically you are increasing the debit. So this 7, we shall now add it to the corporation tax of 20 to get a tax expense of 27. Otherwise, listen, because it could happen. Otherwise, assuming, for purpose of assumption, assuming the balance brought down was 10, let me assume was 10. Then the question told you deferred tax to be maintained at 7, the way it is. It means, therefore, I would have not got the charge to be 7. This time, I would have got the charge to be how much? 3 on the debit. That is what I would have taken to the P&L account. So this time, I am reducing the deferred tax from 10 to 7. How? By debiting deferred tax. So this time, you have debited deferred tax. Having debited deferred tax, what about in the P&L account? I've told you, if you look at P&L account in a T format, profit before tax is always credited, out of which you normally pay corporation tax. Then you argue about deferred tax. We have debited deferred tax by 3, which automatically means you must go and credit P&L account. So you come and say a deferred tax, that is 3. So it means this time you are crediting P&L account. While on the debit, there is that corporation tax of 20. So the question is, by me crediting P&L account by 3, am I increasing the corporation tax of 20, or am I reducing the corporation tax of 20? We said anything credited in an account automatically reduces whatever is debited in the account. So automatically, this time, with that 3, you would have deducted. That is 3. So I've just reminded you what we did last time, concerning the debate on deferred tax. This is not the only language I told you on how it can be tested. There are many ways the examiner can test you concerning deferred tax. Other times he tells you in your past papers, transfer 2 million to the deferred tax. Other times he says transfer deferred 20 million from the deferred tax, increase deferred tax by 20 million, reduce deferred tax by 20 million, or whatever it is. The language is different. Good. So let's go back to ours as it was originally. Ours, we were given a balance brought down of 0. That's what we saw. I don't know whether you had copied this account. 0. Then we carry down a balance of 7. Then I told you, now that we are carrying down 7 and the brought down is 0, then the charge for the year, I told you, will be the balancing figure, and it looks like to be on this side. You come and see a balancing figure, that is 7. So it looks like the carry down and the charge is the same. Why? Because there was no brought down. There was no brought down. Good. So that's all for that note number 3. That's all for that note number 3. So let's go to note number 4. We discuss again note number 4. If there is any workings to be done, we do it. If it is just there for information, we just know that it's just there for information purposes. Good. So let's go to note number 4 now. We are through with note number 3. We are now through with note number 3. What about note number 4? Is there anything we can say? Adding, thank you. So our note number 4, let's check. Let's look at note number 4. Is there something that they are testing you on? Good. Number 4 says, during the year, the company sold an equipment which had a cost of 15 million with an accumulated depreciation as at 1st January 2014 of 3 million. An item of plant was also estimated to be impaired by 4 million during the year. That's about a disposal of an asset. Now listen, of course, you know disposal goes with the depreciation. So note number 5, we can read it together. It says, depreciation rate as per the company's policy are as follows. On buildings over the useful life, of course, we have already depreciated the building by 40 million, over 40 years. Then you are given plant and equipment, which is the one we are dealing with, for 20% reducing. It is the company's policy to charge a full year's depreciation in the year of asset purchase and none in the year of disposal. Depreciation, the company treats depreciation of plant and equipment as a cost of sales and on land and building as an administrative expense. Let me explain. Here they are testing you on disposal of assets. Listen. That area is not a financial reporting area. It is a financial accounting thing that you did in financial accounting. Now, for that point, let me mention this. As at that point, whenever the examiner is testing you on published accounts, listen, he can test you on anything you did in financial accounting. We are not supposed to teach disposal of disposal of assets at this level. No. But you did the topic of disposal of assets in financial accounting. And you know, whenever a company disposes an asset, you must determine the gain or loss on disposal of the asset. And to get that gain or loss on disposal, you also have to remember there were some steps you had to follow. There were many entries you had to make whenever you had to determine the gain or loss on disposal. So that's all the examiner was testing you in note number 3. That there was a plant and equipment which had a cost of 15 million with an accumulated depreciation of 3 million, which was disposed on 1st January 2014. Then, of course, another asset was impaired. Forget about the impairment for now. First, we want to concentrate on the disposal. Whenever an asset is disposed, what are the steps to be followed in the determination of the gain or loss on disposal? Those are the things we want to remind ourselves. I've told you, it's not a financial reporting item. No. So it can be tested by now. This topic of published accounts can include anything you did in financial accounting. Whether it's correction of errors, there are questions that test you. As a note somewhere, you are told an error was committed, blah, 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 blah. So you are supposed to correct it. And many other topics that you did in financial accounting. Good. So this one, they are testing on one of the areas you did, and that is disposal of shares, disposal of assets. Now, you know, let me just help you to remember whenever an asset is disposed, there are normally 4 steps to be followed in the determination of the gain or loss on disposal. And those are the steps we want to follow now in order to determine how much is the gain or loss on disposal. Now, listen, we are doing note number 4. Now, one thing you must remember, listen, whenever a company disposes an asset, that asset must be removed from the books. That's always the first thing. You transfer the cost price of the asset sold from where? From the asset account to the disposal account. Now that you have sold the asset, remove it from the books and take it where? To the disposal account. So let's open an asset account. Let's open an asset account. Or in other words, you know the accounts that you used to open whenever an asset is disposed. What is the name of this account asset? That's what I want to pick. We are given note number 34. We are told during the year, the company sold an equipment which had cost 15 million. Good. If you look at the trial balance up there, If you look at the trial balance up there, we have plant and equipment. The cost is 258, and an accumulated depreciation of 126. Good. So let's open the various accounts. One of the accounts you normally open is an account of the asset. Our asset is called plant and equipment. So open that account, make it about 4 lines for that account of the plant and equipment. Another account you normally open, you remember, if you remember your financial accounting, another account you normally open is an account called provision for depreciation. Provision for depreciation. So open it, make it about 4 lines also. The other account you used to open was an account called disposal. If you remember, you also used to open an account called disposal. Good. So those are the various accounts you used to open. Those are the various accounts that you used to open. So let's go through the accounting entries. I have told you the first thing you must do whenever an asset is disposed is to remove it from the asset account and take it to the disposal. But before we remove it, bring down the cost first. Come and see a balance brought down. Let's go to the trial balance and pick the cost of the asset. Pick the cost of the asset. We also need to bring down the accumulated depreciation of that asset. We also need to bring down the accumulated depreciation of the asset. So from the trial balance, what is the cost of the asset? What is the cost of the asset? That's what we want to pick. I can see from that trial balance, the cost is 258. 258. Bring it down. That's 258. Then we go back, check what is the accumulated depreciation on that on that plant. From the same trial balance, I hope you can see up there, plant and equipment, accumulated depreciation is 126. Bring it down, 126. Good. So we go back now to the additional information. I already know the figures. They have told us, note number 4, a plant with a cost of 15 million was disposed. It had an accumulated depreciation of 3 million. Let me confirm that. Yes. Note number 4 says, during the year, the company sold an equipment which had cost 15 million with an accumulated depreciation of 3 million on 1st January 2014. So we sold it during the year, but by the beginning, it had been depreciated by 3 million. Somewhere they have told us the policy is to charge full in the year of purchase and none in the year of disposal. That's why they are not giving you the charge for the remaining few months that they have used it. We are only told by the beginning of the year, it had been accumulatively depreciated by 3 million. Why? Because after that, we used it for some time before we disposed it. But the policy is not to charge in the year of disposal. But let's take, now listen, I want to take the 4 steps of disposal so that we determine the gain or loss on disposal. So step number 1, mlikuwa mnasema, transfer the cost price of the asset sold from the asset account to the disposal account. How? By crediting the asset and you debit disposal. So go and credit the asset. The cost is 15 million and you debit disposal here, and you come and see your plant and equipment. That is 15. That was step number 1. Transfer the cost price of the asset sold from the asset account to the disposal account. Transfer the cost price of the asset sold from the asset account to the disposal account. That's step number 1. Step number 2, you remember? Listen, let me just remind you. As a company, you have been depreciating this asset and carrying down its balance. Depreciating it and carrying down. Depreciating it and carrying down the balance. Listen, now that you have sold the asset, do you need as a company to keep its depreciation in the books? No. So step number 2 said, or used to say, step number 2 is to transfer also the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. So you had to remove the accumulated depreciation of that asset. We no longer need to keep the accumulated depreciation in the books now that we have sold the asset. The note number 4 has told us the accumulated depreciation was 3 million. So we need to remove it from the 126. Remember, together with the other plant and machineries, we have been depreciating them, carrying down the balance. Depreciating them, carrying down the balance. So out of this breakdown of 126, there is a 3 million there, which is for the asset that we have sold. So remove it from there and take it to the disposal account. So come and debit provision for depreciation. Come and debit provision for depreciation by that 3 million, and you credit disposal, and you credit disposal, and you say your provision for depreciation. That is 3 million. Normally that's step number 2, which says transfer the accumulated depreciation of the asset sold from the asset account to the disposal account. Transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal account. So I've already debited provision for depreciation, I've credited disposal. I may not want to ask you what is the 3rd step. I've told you there are normally 4 steps to be followed in the determination of the gain or loss on disposal. Just to remind you, I've said you had to go through the 4 steps. Now, step number 3, if you remember, was you had to record the cash received on disposal. You had to record the cash received on disposal. So we need to go back to the question and find out, well, how much did we sell this asset? I think that was given to us in the trial balance. That was given to us in the trial balance. How much was it? If you look at the trial balance, the last item in the trial balance, is they are giving us proceeds from sale of equipment. The amount is 7 million. So we sold the equipment for 7 million. So we record that amount. Of course, the double entry is with the cash you are receiving, you normally debit cash and you credit disposal. So come and credit cash at disposal. You say your cash, 7 million. That is step number 3. That's step number 3, which says record the cash received on disposal. I hope you have not forgotten your last step. Your last step used to say what? Determine the gain or loss on disposal as a balancing figure in the disposal account. Determine the gain or loss on disposal as a balancing figure in the disposal account. So let's get the balancing figure now. So on the debit side of this disposal, I can see 15 million. On the credit, I can see a total of 10 million, which leaves me with a balance of 5 million on the credit. That is what you take to the P&L account, and it's our balancing figure. We need to conclude, is it a gain or is it a loss? I hope you still remember whether it's a gain or loss. I hope you still remember whether it's a gain or loss. Now, did we sell our machine or our equipment at a gain of 5 million or at a loss of 5 million? Let me just hear from somebody, because I've just been talking things you should have been reminding me. But let me now hear from you. This 5 million, will you take it to the P&L account as a gain or loss? Andika tu somewhere kwa chart, gain if you think it's a gain, or if you think it's a loss, just write loss. I have just been reminding you what you used to do in financial accounting. But now let me see whether you can remember what you used to do. This last step, which is the balancing figure of 5 million, were you taking it to the P&L account as a gain or loss? Somebody has said it's a loss. Another person, what's your opinion? What's your opinion? Somebody has said it's a loss. You chat. Somebody has said a loss. One more opinion. I'm not saying they're wrong. I'm not saying they're right. I just want to hear somebody else's opinion. Gain or loss? One more opinion. Loss. Good. Thank you. It's a loss. That's correct. It's a loss. And of course, listen, just to remind you again, there are two ways in which you can know it's a loss. One way is to look at the double entry. Double entry can be able to tell you whether it's a gain or loss. What's the double entry? I have credited the disposal. I have credited disposal, which automatically means I must debit P&L. There is no way you can debit profit and loss with a gain. Losses are always debited in the P&L account. So from the double entry system, I can tell that these are losses because you must go and debit P&L. Gains cannot be debited in the P&L account. They have to be credited in the P&L account. That's one way of knowing that this is a loss. The second way is to argue this way. This plant costed me 15. It costed us 15 million. By the time we were disposing it, it had cumulatively lost value through depreciation by an amount of 3 million. So it means by the time I'm disposing this asset, it had a book value of how much? 12 million. It had a value of 12 million. But I sold it for how much? I sold it for 7. So if I sold it for less than its book value, then I must have sold it at a loss. I must have sold it at a loss. So that's how we are determining that the 5 million is a loss, that the 5 million is a loss. Now listen. Are we through with the question or that note? Listen, the answer is no. Listen carefully. The answer is no. Listen. For the disposed asset, listen, for the disposed asset, I am through. Those 4 steps. Whenever you want to determine the gain or loss on disposal, we have said there are normally 4 steps to be followed in the determination of the gain or loss on disposal. There are those 4 steps. 1, I've said transfer the cost price of the asset sold from the asset account to the disposal account. That's what we have said. Transfer the cost price of the asset sold from the asset account to the disposal account. Step number 2, we have said transfer the accumulated depreciation of the asset sold from the provision for depreciation to the disposal. That's step number 2. Step number 3, I've told you, record the cash received on disposal. Step number 4, determine the gain or loss on disposal as a balancing figure. Now, Having done those 4 steps, listen to this now. You also remember that once you are through, even in financial accounting, I'm reminding you something you did in financial accounting. Once you are through with the asset sold, you did not stop at that point in time. No. You remember, you had to depreciate. Listen, you had to depreciate the assets that are still remaining. So if you look at this account called plant and equipment, we had assets costing 258 by the beginning. We disposed one costing 15 million. We are remaining with assets costing how much? Those are the ones you must depreciate by the end of the year. And the cost is 258 minus 15. I'm remaining with 243. So once you're through with the assets sold, you must depreciate the ones still remaining. Now listen. So we want to come to this account called, we want to come to this account called provision for depreciation and come and say here to the P&L account, what is the charge for the year? You must depreciate the ones still remaining by debiting P&L account and crediting provision for depreciation. Now listen carefully, because that's another area one has to be careful. And it's one which used to be a bit tricky. Listen, it's true we are remaining with assets costing 243 according to the asset account. But how am I depreciating the remaining ones? You have to go back to the question and find out what are they telling us to be the rate of depreciation and what is the policy. If you remember, we read note number 5 and it told us plant and equipment are depreciated at 20% per annum on reducing balance. Let me take you there. Plant and equipment, that was note number 5. Depreciation rate, they are telling you on the company's policy are as follows. The second one is plant and equipment, 20% reducing balance. Policy, full in the year of purchase, none in the year of disposal. Now, listen carefully, because some questions change. If the question had told us that we are depreciating the assets at 20% on straight line, 20% on straight line basis, that means 20% on cost, then I can take 20% of that 243 and that becomes the charge for the year here. If the question told us that we are using straight line method, then you know straight line method says you apply a percentage on the cost. So I would have taken 20% of the 243 to be the charge for the year. But this time, the examiner is not asking you to use the straight line method, is asking us to use reducing balance method. And you know, when you are using reducing balance method, to get the charge for the year, you apply a fixed percentage on the net book value of the asset, not on cost, on the net book value. So you needed to ask yourself from this question, yes, the cost of the asset is 243, but what is their net book value? What is their net book value? Once I know their book value, now I can take 20% of their book value, not of the cost. Now, let me just take you through slowly because of time. Now, you know, to get the net book value of something or an asset, you normally take the cost minus what? Minus accumulated depreciation. Don't write this fast. Yes, I know the cost is 243, but I'm not using straight line method, I'm using reducing balance method. So I need to ask myself, what was their accumulated depreciation? These assets that are still remaining, having a cost of 243, what was their accumulated depreciation? Now listen. You remember, we began the year with assets costing 258. Those assets which had a cost of 258, look at it now, they had an accumulated depreciation of 126. The assets had a cost of 256 and their accumulated depreciation as per the trial balance was 126. Listen. Then, out of the 256, we sold one whose cost is 15 and whose, listen, and whose accumulated depreciation is that 3 million. So what does it tell me? It tells me if 126 is the depreciation of all of them, including the depreciation of the one sold, but out of this 126, 3 million is the depreciation of the asset that was sold. 126 is the depreciation of all of them, including the depreciation of the one sold. But out of that 126, we now know 3 million is for the one sold. So it means what? It means if I take this 3 million and subtract it from 126, if I take the 3 million and subtract it from 126, that would leave me with the accumulated depreciation of the assets not yet sold. 126 is for all of them, but out of 126, 3 million is for the one sold. So it means if I take 126 and I remove 3 million, which I remain with 123, 123 now represents the book value, represents the accumulated depreciation of the assets not yet sold. So I come and minus from now the cost, which is 243, I minus 123. Once I do that, I'll be able to get the net book value. And it's on that net book value that you apply your percentage, which is 20%. So the question here was a bit tricky in the sense that the examiner wanted you to remember, listen, that once you're through with the assets sold, you've got the gain or loss on disposal, you normally don't have to stop there. This is something you did in financial accounting, in the sense that you had to remember that once you have dealt with the assets sold, you had to depreciate the ones that are still remaining. So the first thing to do was to go to the asset account, get the balance carried down. That balance carried down represents the cost. Once you know the cost, go back to the question and ask yourself, what's our policy of depreciation? Are we using straight line method? Are we using reducing balance method? I've told you. If the question was one where we were using a straight line method, maybe 20% straight line or 20% on cost, I would have just taken 20% of 243, and that would be the charge for the year for the remaining assets. But now I'm not required to use straight line. I'm required to use reducing balance. And you know reducing balance method says a percentage on the book value, net book value. So I needed to know these assets that are a cost of 243, what was their net book value? Good. So with that idea now, let's put down that working properly now. With that idea now, I want us to put down that working. So andika somewhere down here. Andika somewhere here. Determination, put it down. Determination of the depreciation charge for the year. Determination of the depreciation charge for the year. Determination of the depreciation charge for the year. Then you can come and say number one, you say this, accumulated depreciation of assets or plant and equipment, put it that way. accumulated depreciation of the plant and equipment still remaining. Determination or accumulated depreciation of the plant and equipment still remaining. I've told you all of them had an accumulated of 126 million. I removed 3 million for the one sold. That we have agreed is 123 million. So 123 million is the accumulated depreciation of the assets that are still remaining. Okay, good. After I'm through with that, now I come to number 2. I want to determine the net book value of, we can even now say, assets still remaining. Net book value of assets still remaining. Then you can come and say here, net book value equals to cost minus accumulated depreciation. We have agreed the cost was 243. From our asset account, we have seen that. From our step number 1, we have got 123. So that leaves me with how much? 243 minus 123 looks like exactly 120 million. Now I know the book value. Now I can get the charge for the year. So I come and see your number 3 now. Depreciation charge for the year. This will now be 20% on the book value, which is 120 million. So this time we are depreciating our assets that are remaining by 24 million. Good. So let's take it now back. Let's now take it back to our provision for depreciation by charging that 24 million now. Hoping you're through with the copying. Hoping that you're through with the copying now. So let's take it back now to the account called provision. So now we are depreciating our assets by 24 million. Now we can close our books. Already I've closed the account called plant and equipment. That one is already closed. The only one remaining, disposal, we have already closed it. Now we go to this next one, provision for depreciation. What is the accumulated balance by the end of the year? Balance carried down. This looks like 150, if I'm correct. 126 plus 21, 24, plus 24 looks like 150. If I minus 3, that leaves me with 147. Good. So we are through with that note number 4 and even number 5. 4 and 5 were going together. It was about disposal and about okay. So let's see what note number 6 is about. I don't know whether we shall be able to finish the question. We may not be able to finish it. But let me see what note number 6 is about. That one I can explain. Good. So finish. I put down, we discuss note 6. Note 6 is what I want to finish, to discuss. So finish copying that provision for depreciation. Then I discuss note number 6. I hope you are through with the copying now. Good. Let's read note number 6 now. Number 6 says, Dollar Limited values investment property at fair value. The fair value of the investment property as at 31st of December 2014 was 586 million. Listen, this company has an investment property whose fair value, which is valued at fair value. Then you're told the fair value of the investment property as at the end of the year is what? 586 million. From the trial balance, what was the value? From the trial balance, what was the value? Below there, I hope you can see from the trial balance, the value is given as 548 million. 548 million. Good. Somebody's asking a question. Question. Credit balance is always a gain. Credit balance is always a gain, as you have taught. Why changes? Which change? Which change? Which credit balance are you talking about? Who is this? Hussein? Which credit balance are you mentioning there? I've not changed anything. It's always a gain. Ama, you want to talk about this 5 million? Listen. Listen. I've told you, a credit balance is always a gain. That's true. Which one are you talking about? Hussein, which gain are you talking about? I have not changed my position. It's always a gain. I don't know whether you are discussing about the 5 million, that one we have got in the disposal account, or what. Which gain are you talking about, Hussein? So that we help you. You have said, why changes? It's true, I've said, credit balance is always a gain. Then you have asked, why changes? Which one have I changed? That's what I want to find out, so that you clarify, I help you. Okay. Sawa. Let's go on. You will call me after this. You will call me after class. You will call me after class to explain which one. Maybe you may not be able to chat. But if you are able to chat, you can chat. If you are not able to chat, you will call me after this. I will explain. Sawa. So let's go on. Let's go on. Now, I was talking of, listen to this now. We are told this company has an investment property whose fair value is 586 million, according to the additional information. From the trial balance, it had a value of 548 million. Now listen carefully. First, the examiner wants you to know, listen, what is an investment property? What is an investment property? 2, what are the accounting treatments for investment property? Now, I want to go through a short accounting standard for this property. There is an accounting standard for investment property, and the accounting standard is IS number 40. So let me go through. There is an accounting standard IS number 40 for investment property, and it has various methods of dealing with investment property. This is just one method that the question has talked about. So now listen. Assuming as a company, let us assume you are a manufacturing company. You are a manufacturing company and you bought, listen, you bought a building with the hope, listen, that the value of the building will appreciate in value, and you will be able to sell that building and make what we call a capital gain. It could be you bought this building or you bought land, and you are hoping that the value of the land or the value of the building will increase in value, and then when you shall sell, you will have what we call a capital gain. Or, again, you are a manufacturing company, you bought a building, and you want this building to give you what we are calling rental income. Remember, you are not using the building to run your business. No. you are using it to generate rental incomes. And yet I've told you, you are a manufacturing company. And yet you have a building which you are using or you are holding in order to generate rental incomes. Listen, when you have such an asset, IS number 40 says it should be called an investment property. So an investment property is an asset which is held for either, listen, for either capital appreciation in value or for appreciation in value or for generating rental incomes. Any asset that your company is holding with the aim of capital appreciation in value or for generating rental incomes, then that kind of an asset is classified as an investment property. So let's assume you bought this building for, let's say, 200 million. That's how much it costed you. Now, there are two methods that the accounting standard requires you as a company you can choose from in treating this investment property. Now, we are not calling it a building. It's an investment property. One, you can maintain it in your books at what we call the cost model, or you can use another model we call the fair value model. If you choose that you're going to use the cost model in dealing with this building, then you will take that cost of the building and depreciate it as normal. That means deal with it as a normal fixed asset. It costed you 200 million. Maybe it has a useful life of 40 years. So it means every year you'll be depreciating it by how much? 5 million. So in the balance sheet of year one, it will have a book value of 195. Second year, 190, 185. That way, that way. So that's one method. Cost model, where you deal with it as a fixed asset like any other fixed asset. The second approach is what we call the fair value model. This machine, or this building, costed you 2 million. You may find out that by the end of the year, this building has a fair value or a market value of 250 million. That's the fair value. So in your books, listen, you will reflect it in your books at 250 million if you choose this model, the fair value model. Then, listen, the difference between the 200 and that 250, that difference of 50, which is a gain, now you take it to the profit and loss. Now you take it to the profit and loss. So that is the fair value model. So we have said, if you are maintaining your asset at cost model, then deal with it like any other fixed asset, meaning you depreciate it over its useful life, just like any other fixed asset. I've said, if you are choosing the fair value model, then maintain the asset at the end of the year at its fair value. And the change in fair value, don't forget it costed you 200 million. That means the market value that time, that was the fair value or the market value that time. It was 200 million. But by the end of the year, it's worth 250. So that change in fair value should be taken to the profit or loss, to the profit or loss. So those are the two methods. So this question talks about which one? They are talking about fair value model. They are talking about fair value model. Sawa. Good. So fair value model, that's what they are using. So we shall compare the original fair value according to the trial balance with the fair value we are given as per note number 6. Then the difference is what we shall take to the P&L. And in the balance sheet, we take the fair value, which is 586 million. Good. So I think I've explained that. So that is something we shall put down in a short while. But what about note number 7? Let me just see what number 7 is talking about, because it's the last one there. Number 7 talks about during the year the company made a 1-for-3 bonus issue, capitalizing its general reserve. This transaction has not been accounted for. Obvious, that does not affect P&L account. Bonus shares affect the statement of changes in equity, which we shall prepare later. So it looks like, listen, I've explained all the items according to the additional information. So what we shall do next time, because we are not able to finish, listen, next time I'll give you the summary notes. I'll give you the summary notes on this fair investment property about that I've talked about. Then from there now, we can now do the income statement. Now we can do the income statement. So allow me to stop there for now. We pick it up from there now. Okay? Now, Hussein has said about the 5 million. Listen, Hussein has talked about that 5 million in the disposal. That is a loss. This is not an... Listen, Hussein, this is not a credit balance. Where? Listen, even if you are to balance this account, assuming there was no P&L here, assuming you are to balance and you come and say your balance carry down, assuming you are to say balance carry down, listen, would you say that this account has a debit balance of 5 million or a credit balance of 5 million? Somebody help me now. Assuming we were to balance the account called disposal and carry down that 5 million, would I have said that this account has a debit balance or a credit balance? Somebody to chat. Very fast, very fast. Somebody to chat. If I was to carry down that 5 million, the way I'm assuming, would I have said that account called disposal has a debit balance or a credit balance? It is obvious, listen, it would have a debit balance. Listen, it would have a debit balance. Listen carefully, Hussein, now. Meaning, we first carry down the balance of an account, but then you come and say your balance brought down 5 million. We normally determine the balance of an account. Listen, Hussein, we normally determine the balance of an account by where the balance brought down is, not the carry down. So don't assume that because the difference was on the credit side, it's a credit balance. No. If I was to balance this account, assuming I was to carry down the balance, the account will still have a debit balance. Why? Because we don't determine the balance of an account by where the carry down is. You normally determine the balance of an account by where the brought down is. Are you okay, Hussein, now? And the brought down is on the debit side. The brought down is on the debit side. So this account has a debit balance, not a credit balance. I hope you're saying you have understood now. Yes, we determine the balance of an account by where the brought down is, not where the carry down is. The other point you need to know is this. You cannot have, listen to this, you cannot have a brought down without a carry down. So you normally first carry down the balance, then you bring down the balance. So this account would have had a debit balance. So don't look at which side the figure is. No. It is to know whether an account has a debit balance or a credit, look at where the carry down, the brought down is. Look at where the brought down is. This was 5 million, so we are going by hours. This was P&L account. Otherwise, I've explained, even if we were to balance the account, it will still not have a credit balance. It will still have a debit balance, because we determine the balance of an account by where the brought down is. I hope Mr. Hussein has now benefited. Good. Now, before we close the meeting, listen to this now. Before we close the meeting, I want to talk to the new students now. There are some new students who are here because today it was a free class. Now listen, to you new students, if you wish to continue with us for the financial reporting, if you wish to continue with us for the remaining section of financial reporting or syllabus or semester, our financial reporting timetable is we normally meet every Tuesday. We normally meet every Tuesday, Thursday, and Friday. All of them from 8 p.m. to 10 p.m. That's the timetable. Now, this is for financial reporting. Now listen, our system is such a way that in case you miss a class, assuming on a Friday you are too busy and you can't attend the class, does it mean that the class for that day is gone? No. You can go back to the group where the link was posted and you click on the link and you'll be able to watch your video at your own free time. Or maybe I have taught you and you feel you want to listen to the class again, just go back to the group, click on the link, and you'll be able to watch your class again. That's a good thing about our system, that in case you miss a class, you can still be able to watch your video at your own free time. Okay? Now, for those students who feel they may not be available at this time, you can also buy what we call pre-recorded videos. You can buy what we call pre-recorded videos, whereby you get the videos for the whole syllabus all at once, and you listen to them at your own free time. You listen to them at your own free time and at your own pace. So you can also buy the pre-recorded videos. You can also buy the pre-recorded videos. Now, currently we are charging 4,000 shillings. We accept payments in installments. That's acceptable. If you are interested, then you can call me on this number 0722 658875. If you are interested, you can call me on that number. Once you join, we shall also give you the videos of the classes that you have already missed. We shall give you the videos of the classes that you have already missed. We have already covered some topic, so you can still get the videos of those classes. So I think I'm through with everything concerning that. I've also told you, please subscribe to my YouTube channel. I've reminded you at the start, please subscribe to my YouTube channel so that you get notifications about future videos that will be posted to the YouTube. Okay, now listen. Of course, my YouTube channel is called CPA Joseph Njuguna. CPA Joseph Njuguna. That's the name of the YouTube channel. That's the name of the YouTube channel. Now, some of you have friends who are doing advanced financial reporting. We also have classes for that. And for advanced financial reporting, we normally have what we call early morning classes and evening classes. Our early morning starts from 5:30 in the morning to 7 a.m. in the morning, 3 days in a week. Evening classes starts again from 8 p.m. to 10 p.m. every 3 days in a week again. So for those friends, for you who are friends who are doing advanced financial reporting, you can also tell them to join. They can also buy the pre-recorded videos. They are also available. They can also buy the pre-recorded videos. For those friends of yours who are doing financial accounting of the foundation level, we also have it. Foundation or even ATD. There is also an accounting paper there, either ATD1 or ATD2. Those who are doing financial accounting. Good. So that's all I think I can say concerning that. So if you are interested, I've said, you call me on this number 0722 658875. We shall talk for those who wish to continue with us for the online classes. Okay. Otherwise, have a good night. Have a good night. See you next time, where we shall now continue. I've said I'll give the summary notes on the investment property. Then we shall now do the income statement for this company now. Then from there, we do the statement of changes in equity and the balance sheet. That's what we shall do next time. So maybe for now, we can stop there. We pick it up from there next time. Okay. Good night. For any newcomers, I hope you have understood. You've got something. For any newcomers, I hope you have got something. For today being a free class, maybe if we have somebody who's new and he wants to put a comment, can put a comment there. Otherwise, have a good night. Good night. Good night too. Oh, okay, Hussein, you have said you have well understood now. Okay. So have a good night, everyone. Good night. Good night.